Hello, I am Mijun from the American Stock Exchange University. Let's start today's big stock news on April 10th. As always, we welcome you to Mijun, who is maintaining the stronghold of American stock investors. Due to my personal schedule, this week and next week, it's a difficult situation to send the Mijun broadcast normally. But the situation with the United States stock market is not very good, so I was a bit worried. At times like this, I need to gather more information and share it with you all, but I was quite worried because I couldn't properly broadcast. But suddenly yesterday, Trump, knowing my feelings, boosted the United States stock market. So today I made a very short video to share with you. I think I can digest the schedule with a bit of a light heart. Well, then let's start today's Big Tooth news, which I'll send on April 10th. First, let's try to organize what happened yesterday. The S&P 500 map is really filled with a bright color. Not only are almost all types filled with this color, but this color is a very bright color. So overall, all the types that make up the S&P 500 showed a scene where they all exploded at once. Yesterday, Dow Jones rose 7.87%, the S&P 500 index was plus 9.52%, and finally 12.16%. In other words, it would be appropriate to say that it was a day when the word explosion was appropriate. What is the reason for all three major indices soaring like this? As many of you may already know, Trump has announced a 90-day grace period for most of the trade sanctions excluding China. This is the Trump push we've been waiting for. Why have we continued to hold out hope and wonder about the United States stock market? We were waiting for two signals. The first was the Trump push, the second was the annual push. But now, in the case of the annual push, there is a possibility that inflation could continue due to the influence of the tax, so it has become a bit difficult to expect. So unless there is actually some contraction in the economy, the possibility of the annual moving was extremely low. Well, in the midst of that, Trump finally moved. With that, the United States stock market was able to start rebounding suddenly because the long-awaited recession had burst, as you can see. Yesterday's performance of the mid-cap was also great, with yesterday's strategy soaring by as much as 24.76% the best, and Tesla, which had been underperforming, soared by 22.69%. Thirdly, the stock with the highest drop rate was Credit Tech Analytics, which plummeted by 22.58%. Furthermore, 19.19%, Palantir 19.00%, Nvidia 18.72%, Broadcom 18.66%, Innodata 15.64%, Vistra 15.49%, Meta 14.76%, B2 14.32%, Taiwan Semiconductor Manufacturing Company 12.29%, and Amazon 11.98%. Most stocks jumped over 10%, making yesterday an exceptionally strong day. I don't think there's a need to go into detail about what happened yesterday in today's broadcast. I think many of you would have heard the good news yesterday, as it spread like wildfire across various media outlets that had been sending out extremely depressing news until then. In my view, the most important and curious part now is, the question is whether yesterday's rebound signals the start of a bull market, or whether we can't yet say that the bear market is over. The outlook for the future is crucial. So we must not let our feelings or emotions cloud our judgment. It would be nice if we could predict future situations based on historical statistics. That's what I want to say. Why? Because until now, we've anticipated the United States market's ups and downs by examining historical statistics and staying patient, without being swayed by feelings or emotions. That's why our investors have held their ground. The content I shared a few days ago, it won't be any different this time. According to this content, there have only been 4 instances in United States stock market history where it has plummeted nearly 5% continuously. And looking at the history of the past, both in the short term and in the long term, after the United States stock market has plummeted like this for 2 days in a row, a bull market often followed. We could have examined this part, right? So, in today's broadcast, Like this, over 10%, it was under 10% based on the S&P standard, but it showed almost a 10% plunge, and in the case of Nasdaq, it plunged over 12%. Well, if that's the case, yesterday it recorded the second largest surge in history. Well, after the United States stock market recorded a historic surge like this, it would be good to focus here on what kind of movement the United States stock market showed. First, we will review the history of Nasdaq. As shown here, yesterday's surge was the second largest in history. I left the first place out. Why? Because on January 3, 2001, the National Association of Securities Dealers Automated Quotations Index had a whopping 14.17% surge, and so yesterday was in second place. If you look at the third place, it was October 13, 2008 during the global economic crisis, and the fourth place is dot-com bubble, and the fifth place also includes 2008, 2020, 2001 dot-com bubble, and besides that, 2020 pandemic, and finally, the dot-com bubble appears once more. So, until now, when has the National Association of Securities Dealers Automated Quotations recorded the highest winning rate in history? In conclusion, we can see that all the focus is on the dot-com bubble, global economic crisis, and pandemic. Well, it would be good if we could look at the historical statistics to see if this period was really a bottom, in other words, the lowest point. So, as shown here, was the dot-com bubble period the lowest point for Nasdaq? It was recorded on October 9, 2002. Now, as you can see here, January 3rd, 2001, and then December 2000, April 2001, April 2001. So, if we try to sort it out, it seems a bit difficult to assume that this time was the bottom, as it showed a tremendous upward trend like this. Let's take a closer look at the second case. The lowest point of National Association of Securities Dealers Automated Quotations during the 2008 global economic crisis was on November 20th, 2008. Now, if you look here, on October 13th, 2008 and October 28th, 2008, there were huge spikes. So, if we base it on the 2008 global economic crisis, after such a surge in stock prices, the bottom came quite quickly, so it's possible to assume that the bottom has been formed from now on. Now, the third reason why the pandemic is important is because we are currently seeing a kind of event-driven downturn like the pandemic. Because of this special event called the pandemic, stock prices are falling, making the pandemic the most appropriate reference. That's what I think. The lowest point of the Nasdaq during the 2020 pandemic was on March 23rd, 2020. But if you look here, there was a surge of over 8% on March 24th, 2020. So the point is, this was the bottom, but it skyrocketed the next day. Therefore, in the case of the pandemic, after the rapid rise of over 8% on March 24th, it did not turn bearish again. This was the bottom. To sum up, based on the history of the United States stock market, we cannot rule out the possibility that the Nasdaq Composite has not yet hit bottom. However, considering the bear market of 2020 created by the pandemic, we can optimistically interpret that we are at least close to the bottom. Well, next we will take another look at the S&P 500 as a benchmark. Yesterday, the S&P soared 9.52%, which is the third largest increase in history. Well, first on October 13th, 2008, and then on October 28th, they each soared 11.58% and 10.79%, recording the largest increases. In addition to that, we see 2020, 1987, 1948, 2009, and again 2020. Well, let's first take a look at 2008. During the global economic crisis, the lowest point of the S&P 500 was on March 9th, 2009. So, if you waited about 5 months after October 2008, that was the bottom. Therefore, we can interpret such a plunge in stock prices as a sign that the bottom is falling out, at least pessimistically. And moving into 2020, the lowest point of the S&P 500 during the pandemic was on March 23, 2020. But if you look here, it came out on March 24th, 2020, and also on March 13th, 2020. So when we based it on the pandemic, if we base it on this kind of event-driven downturn, again, when a steep decline appears, we could optimistically see that the possibility of it being the bottom is extremely high. Looking ahead at the history of the United States stock market, there are 3 benchmarks, and if we base it on the dot-com bubble, more time is needed for the bottom to be reached. We can conclude this. If we base it on the 2008 economic crisis, it's not the bottom yet, but the bottom isn't far off. We can interpret it this way. Lastly, if a somewhat similar pandemic becomes the standard, we can conclude that now is the bottom. We can draw a somewhat optimistic conclusion. Because these three different conclusions have emerged, it would be good to do a bit of technical interpretation this time. Detailed information about the next support line of the S&P 500 is available, so let's read the opinion of a technical expert together. After President Trump declared that the worst-case scenario is practically over, the stock market surged on Wednesday, but this does not mean the end of the bear market. The rally was extreme, but there is reason to believe that sellers still have positions they want to unload and could be waiting for a larger bounce to start selling. I'm extremely curious as to why that is. The S&P 500 index closed at 5,456.90, up 9.5% after the midday announcement of the tax. This marks a downward trend to 5,285.7, the lowest in 11 months, dropping 12.1% over 4 days until Tuesday. So even if it was a tremendous decline, it had stopped the decline, and there is a great significance in stopping this decline. You will see it this way. Well, the problem is, because it was such a steep tax, it falls so steeply like this. There is a tendency for a lot of resistance to remain, so it reminds us that there are a lot of resistances that we need to break through. And the reason for that is, this is because people who want to buy have not responded quickly enough, or have chosen not to buy in a declining market. We usually call this a bear market. Just in one day, the S&P 500 fell by 5% continuously. That's why it fell so quickly. Originally, people who wanted to sell stocks didn't have a chance to sell, or there were many people who decided to sell when it rose due to a drastic drop. You'll see. Well, first of all, what about the first low line? On April 4th, the daily high was 5,292.14, and the daily low on April 3rd was 5,390.83, creating a gap in the chart. This is the part that appears in the picture here. What kind of gap is this that occurs in the market? It represents an area where investors were unable to act. I explained it earlier. I'm referring to the part that couldn't be sold due to its rapid decline. So, if the stock price comes back to that level, it sometimes works as a support. Therefore, investors who want to buy at the resistance level can now act when the opportunity is given. Usually when it comes back to that level, if it bounces back, there are many people who sell there. The S&P 500 experienced some difficulty at yesterday's low point during Wednesday afternoon's trading. However, thanks to a sharp rise during the last hour before closing, it managed to turn this incredibly difficult area upwards, which is where we are now. Therefore, the first resistance line is already breached. The current level is above 5,456.90. There is another section formed on April 3rd after the announcement of President Trump's tariff day, right here. So the current stock price has risen up to here, and there is another gap right above it. So we can see that the second resistance line is right above it now. The day's high of 5,499.53 was significantly below the April 2nd low of 5,571.48. The stock price fluctuates. This is called volatility. Another aspect of volatility is that it sometimes goes into a state of progression. It's completely empty, isn't it? When the market that was bullish reverses and looks for a place to rest, it means that the stock price is inflated like this. What we usually call a unified region. The price range that was previously built can be a strong target point, and many chart experts ultimately assume that all price fluctuations will be filled. What about this story? When it falls too quickly while watching the gap, if the stock price rebounds and goes back into this gap, there is a possibility that it can now receive adjustments here. This is how we can draw a conclusion. There is a technical signal that the rebound on Wednesday can continue. However, even then, it is not thought to be strong enough to fill the gap on April 3rd. This is the opinion of Julian Klimoko, a technical analyst at BTIG, an investment firm, and according to Klimoko, we don't know beyond that, but the 5,390-point gap is expected to be filled. The S&P 500 index's trend reversed only yesterday. It will significantly drop before recovering. And yesterday, as Klimoko said, the first gap was completely filled. And it also satisfied the first major retracement target near the Fibonacci ratio of 0.618 or 1.618. So it comes out like this, the Fibonacci ratio here. It's called the golden ratio or divine ratio. Many monthly chart analysts use this ratio when calculating the target point when the stock price rebounds or falls. The S&P 500 peaked at 6,147.43 on February 19th and hit its lowest point of 4,835.04 on Monday. The task is to calculate the Fibonacci retracement for a number that has dropped from 6,147 to 4,835. And then, if we assume that it goes up to 38.2%, that would be exactly 5,336.37, you see. But now we've broken through this 5,336 from yesterday, and what's the second retracement target? 5,391.242 is 50% usually. If it rises to 38%, it may stop there. If it increases to 50% from here, there's another resistance, a support line. But by a strange coincidence, this is the number right below the bottom of April 3rd. As I mentioned earlier, if a gap appears, there's a possibility it will stop at this gap. I mentioned the support line earlier, but this support line coincides with the current Fibonacci retracement target of 50%. The strong support line we meet in the middle is 5,490. Looking at it this way, you'll see. The final and most important major retracement at 61.8% is 5,646. Why? Because Fibonacci traders and therefore technical analysts who use Fibonacci ratios believe that if a retracement hits the 61.8% range of the previous move, the previous trend will continue. That means if the S&P 500 breaks through 5,646 and the trend is adjusted upwards, then it can now rise towards the 100% target point. This is a possible optimistic interpretation. Well, to summarize. First, there were three targets for Fibonacci retracement. The first one was 38.2%, but this has already been achieved yesterday. The second target is 5,491, which is 50%. This 50% is 5,491, which is the number below the bottom of the lower limit. So I mentioned that the two lower lines have now intersected. First of all, a gap occurred, and there is a possibility that it will be blocked at this gap, and coincidentally, it coincides with 50% of Fibonacci retracement. If it breaks through 5,490, almost 5,500, and if it turns upward beyond that, the last lower line is at 5,646. It seems possible to organize in this way. Let's summarize in one word about Leon. In conclusion, did the United States stock market plummet yesterday? First, there was a gap between 5292 and 5390, and while gently turning this gap, it arrived at 5,456.90. This part is uncertain. Now there is a second resistance line, and this one is formed in a different gap. And whether it's a coincidence or not, it coincides with the Fibonacci ratio of 50%, which is now 5,491, almost 5,500. In reality, the United States market rose to 5,481 during Wednesday's session before stopping and falling at that point. So the fact that there is a lower line here is confirmed again. From a technical perspective, it's crucial for the United States market to surpass 5,500 in the coming days and sustain the uptrend. And ultimately, if it exceeds 5,646, which is the main turning point, namely 61.8%, this downturn is finally over. Now it will rise, and we can interpret it positively like this. But the final 61.8% indicator is 5,646, correct? But this range is also incredibly tight. Why? Because the 200-day moving average of the S&P 500 index is in this area. And usually, if the 200-day average of the S&P 500 is broken, it's very bearish. And if it breaks again and goes up, it's very bullish. In conclusion, when I first mentioned it, we need to watch if it exceeds 5,500. And if it exceeds 5,500, there is a possibility of rising up to 5,646, and whether it breaks this or not can be a very important variable. This can be summarized like this. Of course, you need to remember that the technical trend can be transferred to the total sales regardless of how much it is. And one negative aspect is that the market directly confirmed the fact that Trump exists yesterday. Therefore, if the market can grow like this, it seems that we can expect it to help turn the technical resistance line. The last content prepared for today is the expert's opinion, and the expert's opinion that we will look at together is: there is a very famous pianist in JP Morgan, Marko Kolanovic, who was once the most powerful pianist in the world, a very capable expert, who even received such a title. You can see it like this. So, how does Marko Kolanovic explain the current situation? And we will try to listen to his opinion. The last content for today, I will try to read together with an artificial intelligence that mimics my voice. That's it for today's broadcast. Thank you for being with us until the end of the short broadcast. I will gather various information that can help your investment activities and come back to greet you tomorrow. Let's all fight together until the day we retire as United States stock investors. Have a happy day, thank you. Kolanovic said in an interview with MarkWatch on Monday evening that he believes the Trump administration will revoke some of the tariffs announced last week. And his prediction was correct. On Wednesday afternoon, President Trump announced a 90-day tariff exemption for all countries not reported in the United States, while tariffs on Chinese products increased to 125%. Kolanovic said in a follow-up interview with MarkWatch on Wednesday that all their plans were ruined as the stock market collapsed. Their first change was that there was an effect on the bond market, but the bond market probably forced their attitude change. This week, as the National Treasury yield rate has risen sharply, the Federal Reserve may have to intervene due to economic concerns about inflation. However, after Trump's announcement, the United States stock market saw a sharp rise on Thursday, and the National Association of Securities Dealers automated quotations composite index rose more than 12% during the day. The S&P 500 also saw a significant increase of 52%, and the Dow Jones Industrial Average rose 7.87%. However, Colorado said that it is not yet ready to give up this lead. This is because there is still something left to give up. Later this week, companies will start reporting first quarter earnings in a situation where they could feel the impact of all the uncertainty surrounding Trump's trade proposals. This could lead to more volatility in the stock market. Kolanovic said there's no need to panic about this volatility. He thinks this is a reasonable and fair price given that we are in the earnings announcement season. He thinks that a few names can be selectively added. If he exercised the option on Monday, he could realize some profits. However, Kolanovic likes the stock at this point, saying the stock has not yet rallied, it's still significantly down. Investors will be watching what impact Trump's policies have on the economy and labor market. According to Kolanovic, investors should closely monitor the weekly jobless claims data that is released. The latest data is set to be released today. He said that he thinks the number of new jobless claims is one of the indicators with a high degree of emptiness. Whether companies have started to lay off employees, this can be known in more detail on Thursday. He also expects to pay attention to the discourse when corporate employees announce earnings and when analysts and conference calls are conducted. Furthermore, Colorado does not think that Trump's trade issue has been definitely resolved. Betting does not think that Europeans will suddenly give everything Trump wants, as the veteran strategist said. However, the Chicago Board Options Exchange Volatility Index VIX, known as Wall Street's fear gauge, suggests that the market will calm down at least temporarily. Kolanovic thinks that the market will no longer experience the major changes that emerged last week. The VIX fell more than 32% to 35.66 on Wednesday. He pointed out that there are still many problems. I don't think we'll record the highest level for a while. I think it's somewhat moderate,